Assalamualaikum. Today we will be talking about technical analysis. Technical analysis. Technical analysis is topic number 6 in your syllabus. Yeah. So this under technical analysis topic, there are 3 subtopics, which are the explanation on efficient market hypothesis, Dow theory and random walk theory, and then type of charts and patterns, and the technical indicators. Okay, if you read the textbook, the technical analysis will cover from page 148 of your, from page 148 up to 164, from page 148 to 164 of your textbook, on chapter 5 of your textbook. Okay, before we begin with technical analysis, let me explain to you a bit about efficient market hypothesis or random walk theory. Actually, efficient market hypothesis and random walk theory referring to the same theory, but the way they put the explanation is a bit different. Let me explain to you what is meant by random walk theory. Random walk theory. Okay, a random walk theory says that the stock prices move randomly. It means that any effort to predict the stock price movement is a waste of time. If you are a strong believer in random walk theory, you wouldn't want to do any of the things that we have studied before, like share valuation, then identifying which stocks are undervalued, which stocks are overvalued. These are the things that people who believe in random walk theory believe that all these efforts will go into waste, or there's nothing good will come out of it. Okay, that is a random walk theory. Another way of saying a random walk theory is an efficient market hypothesis. Efficient market hypothesis. It is essentially talking about the same thing. Efficient market hypothesis says that market is efficient so that nobody can make extraordinary gain in the stock market. So it means about quite similar with what random walk theory says, in which if you are a strong believer in efficient market hypothesis, you believe that stock markets will move at random. So any effort to predict the stock market movement is a waste of time. So you just buy stocks and pray, hope that the stock will price will go up, so that you can make some money out of it. There are 3. We are not going into details all this, but there are actually 3 types of efficient market hypothesis. One is weak form. There are 3 forms of efficient market hypothesis. One is a weak form, and then there's a semi-strong form, and the other one is a strong form. Okay, what does this 3 forms of efficient market hypothesis says? If you let's go to the strong form first. Okay, the strong form of efficient market hypothesis says that in any situation, you cannot beat the market, even though you know something of privileged information, or if you have the ability to do insider trading, you still cannot make money. That is in a very strong form of efficient market hypothesis. In the weak form of efficient market hypothesis, there are ways in which you can make money out of the stock market if you have some privileged information. So in the semi-strong form, it is somewhere in between. We will not delve into detail on these three forms of efficient market hypothesis. It is sufficient for you to know that efficient market hypothesis and random walk theory are similar, quite similar in principle. Okay. However, there are people who believe that market is inefficient, or those people who believe that it is possible for us to make money in the stock market, or it is possible for us to identify which stocks are overvalued and which stocks are undervalued, and from there we can make some necessary actions to take advantage of the situation. Okay. We have studied before on the share valuation techniques and undervalued, overvalued stocks and so on. Those, if you are a believer that the market is inefficient, so you will try to beat the market using these techniques, and also the capital asset pricing model. Another technique, basically in analyzing the stock market, we divide it into two techniques, which are fundamental analysis and technical analysis. So there are two techniques of stock market analysis. Two techniques of stock market analysis. One is fundamental analysis, and the other one is technical analysis. Technical analysis. Okay, we have spent a big portion of our classroom time on fundamental analysis. So when we say fundamental analysis, we go into the fundamentals of the companies and try to identify which stocks are overvalued and which stocks are undervalued. So fundamental analysis basically what we have done before this are basically a part of fundamental analysis, like share valuation, or we have done CAPM. They have studied CAPM. These are parts, and then in previous class we have studied also ratio analysis. So all these are a part of fundamental analysis. Another technique of predicting the stock market movement is by using a technical analysis. So technical analysis is the use of charts. The use of charts to predict the stock market movement. Stock market movement. Okay. Those who believe in technical analysis are either called chartists, come from the word chart, because those who believe in technical analysis, they use charts to predict the stock movement, or sometimes they are also called technician. It comes from the word technical. So those who are a strong advocate or strong believers in technical analysis, they are either called chartists or technicians. These people, they don't bother doing the fundamental analysis. They don't care what business the company in, what type of companies. They don't bother about doing the ratio analysis. They don't bother about doing share valuation and so on. All they care about is how the market will move by looking at the charts. So the chartists or the technicians will only look at the charts. There's one theory that is based on technical analysis, which is a Dow theory. Dow theory is a theory based on the Dow theory is the theory based on technical analysis. Dow theory says that there are three movements of the stock market, and all we need to do is to look at the the major trends. We have three wave or three movements. One is daily movement or daily wave. The other one is minor wave or minor movement, and the last one is major wave or major movement. Okay, let me try to explain this this concept. Look at this graph. If you look at this diagram, this graph, okay, there are some fluctuations of market movement. So it can be a daily or intermediary, pertengahan, intermediary, but the overall trend is going up. So if you are an analyst, you should be looking at the major trend or the overall trend of the market. Even though there are some movement that goes down, but the overall trend for this chart is going up. So we should be looking at the overall trend. Okay, that is actually how the Dow Jones theory says. Okay. You can read in your textbook what are the advantages and disadvantages of technical analysis, and of course if you use technical analysis, since the analysis is solely based on the charts, so there is no need for you to do this to churn the numbers. Churn the number maknanya banyak sangat mengira. Like if we do share valuation, we do ratio analysis, we have to do a lot of calculations to come up with our decisions. But these technical people or technicians or chartists, they don't bother about calculating the intrinsic value of the stock or the ratio analysis and so on, etc. But they only look at the charts, because an analyst, a chartist, believe that stock market moves in a pattern. So and usually the pattern will repeat itself after a period of time. Chartists or technical and technicians percaya bahawa harga saham ini dia bergerak dalam satu corak yang berulang-ulang. So all you need to do to predict the future movement of the stock market, you only have to look at the past movement, because from the past movement of the stock market, you can predict the future movement of the market. That's it. That's how the technical or the technicians or the chartists belief. Okay, of course we have to plot the graph using the technical analysis, since we rely so much on charts. So there are several ways or several methods of recording the market movement. So we have here, if you look at your textbook, there are so many ways to show the market movement. On page 160, from 161 and 163, 161 to 163, we have among the popular charts, that is one is a point and figure chart. You look at page 163 of the textbook. What is a point and figure chart? Okay, point and figure chart looks something like this. Okay, let's say for example, now I'm trying to explain to you what is a point and figure chart. Let's say for example, you are keeping track of a stock market movement. Let's say ABC company. Okay, ABC company. Okay, and we have only three indicators here: a cross and circle. So cross is a sign of when the stock market goes up, and circle is when the market goes down. Okay, let's say for example, so we have price here. Let's say the price is something like you put a range of, let's say for example, from 220 to 25 to 30 to 35 to 40 to 45 to 50. This is in ringgit. This is price. Okay, let's say you start with the price of 225. So you start at 225. You monitor the price movement every day. So let's say tomorrow the price goes up to 230. So you just put here 230. And the day after tomorrow it goes up to 240. As long as the price of the stocks move in the same direction, you don't change the column. So as long as it goes up, you remain in the same column. But let's say for example, after the price goes up to 240, the next day it went down to it goes down to 230. So when it goes down to 230, you change column here, 230. And then the next day it goes up again to 235. So it goes up to 235, you put, and let's say another day it goes down to 225. So 225, and so on, etc. Okay, if you do this repeatedly over a period of time, you will see the pattern. So this is what we call a point and figure chart. Okay. Okay. Another thing that on technical analysis is the technical indicators. Yeah. Okay. The technical indicators is an indicator of how strong the movement is. So if you look at the textbook here, I would like to explain to you, or before we go into technical indicators, I would like to explain to you how we interpret a simple line. How do we interpret a simple line? Let me give an example. Let's say, for example, you have plotted over a long period of time a chart of stock market movement. Let's say it looks something like this. Okay, let's say, so this is the price, this is the price, and this is the time. Okay, over a period of time, the chart will look something like this. Okay, there's ups and downs, ups and downs. Okay, if you draw, this is what you call peak, peak ataupun puncak lah. This is through ataupun jurang. So if you draw, if you connect all these peaks, it will look something like this. And if you connect all these throughs ataupun jurang ni, it will look something like this. Okay, let me adjust a bit. Okay, so this range of market movement is called channel, a terowong channel. Okay, or it's called tunnel or channel. Okay, and if the stock and the lower line is called a support level ataupun garisan sokongan, a support level, and the upper line is a resistance level. So this is a resistance level. Okay, so the lower line is a support line or support level, garisan sokongan. The upper line is a resistance level or resistance line, garisan resistance mean bertahan, not bertahan, resistant. What is resistant in bahasa Melayu? I cannot come up with a Malay word for resistant. Okay, so now if let's say the stock suddenly goes down from this within this channel, and then the stock goes down, so this is a sign that for you to buy the stock, because now it is a sign that the stock is going to be falling in price. Okay, so this is if all of a sudden the stock price goes up, so this is what we call a breakaway. And if this breakaway happens, it is a sign that for you to buy the stock, because of this is a sign that the stock is going to be moving up, the price is going to be moving up. Okay, so now we know what is support level or support line, what is a resistance level. So this is channel, and if the stock price either goes down or goes up, breaking the both lines, we call it breakaway. Okay, one thing that what I show now, what I show in this on the whiteboard is a simple diagram. However, in order for us to avoid from making mistakes, sometimes it goes up and then all of a sudden it goes down again, and we have bought the stock price anticipating that it will go up, but tomorrow, the next day it will go down. So to avoid this from happening, we use we have to what do you call it, we have to, I cannot come up with a word. We have to modify the graph by using, instead of recording the daily movement of the price, we use a moving average. What is a moving average? Okay, let me explain to you what is a moving average. Yeah, everybody knows what is average. Average means average, purata. Yeah? You put together, let's say for example, if you want to calculate the average average weight of students in this class, so you take each student's weight divided by the number of students. Similarly, when we talk about moving average, let's say for example you want to create a 20-day moving average. So there are 20 days, 20-day moving average, there are 30 days moving, 200 days moving average. So what I'm giving an example now is a 20-day moving average. So if you want to create a 20-day moving average, you take, okay, let's say for day one, you take the price of, let's say you are constructing a 20-day moving average for a particular stock untuk satu saham. Let's say 20-day moving average for ABC company, ABC Berhad. Let's say for example you are constructing or you are calculating a moving average for ABC Berhad. So for price one, or you will take the past 20 days of ABC company's price, stock price, up to the 20 days. So you start from the day 1 up to the day 20, and then you add up the price for each day and divide it by 20. So you will have one figure here. Okay. So you get an average of 20 days. 20 days. So this is an average. What is a moving average? Moving average, the next day, let's say the next day, you take price of day 2 plus day 3 plus day 20 plus day 21 divided by 20. You get another price. Okay. So the rule is very simple. You add one day at the price and you drop the earlier day, and you keep on repeating this thing again and again and again. What is actually the purpose of creating this moving average? So that when you record the stock price movement using a moving average, let's say you record any movement of stocks will not be too drastic. You will not be too drastic because it will be based on 20 days average. So on the graph, it will not suddenly look something like this, and you will get a false impression or false alarm, and you buy the stocks just because there's an increase of the stock price only for one day. So by having this moving average, 20-day moving average, any increase in stock price will only be reflected by a little movement on the graph, a very little movement on the graph. So that is a 20-day moving average. Okay. Another indicator that we have to look into is how if there's an increase or decrease in the stock price, we have to look at the momentum of the movement, because the bigger the momentum, the more sign that this movement will last. It's more kalau momentum tu lagi kuat, maka itu adalah petanda bahawa pergerakan itu akan lebih lama. Okay, how do you calculate this momentum? So we have things like breadth of the market. It's explained on page 156 of your textbook, and then we have also relative strength index. Okay, what is a breadth of the market? Yeah, what is a market breadth? Market breadth or breadth of the market. See, it is explained on page 156 in your textbook. Okay, market breadth or breadth of the market or keluasan pasaran, yeah, is simply like this. Okay, every day we have number of stock that goes up, and the number of counters that goes up, and another number of counters that go down. So every day you just tally the number. So how many numbers will go up? Okay, number of counters that will go up, and how many counters that go down. Okay, so the number of counters that go up minus number of counters that go down will give you some figure. So this is negative and this is positive. So let's say, for example, 500 counters that go up, 200 go down. This is just a hypothetical situation. So we have a positive number of 300. You repeat the same process every day. So if more stocks go up as compared to the stocks that go down, so this number will become bigger. So it shows that the bigger the number, the bigger the momentum is. So if the number of stocks minus the number of stocks that go up minus the number of stocks that go down, if the number is big, then it shows that the momentum is strong, and you have a strong belief that this market movement will continue in the future. However, if it is too small, okay, let's say, for example, it has been going on for 300, and then suddenly the values become smaller and smaller, so that is probably a sign that the market is about to turn. Nah, pasaran nak berpusing dah. So it is about so it will give you the signal to be careful with the market and to look at your position. That's it. Until our next lecture. Bye bye. Assalamualaikum.